Traders, investors, and pundits have been largely optimistic about markets over the past few months, saying that the bear market is over, nothing bad can happen. Bulls have been celebrating and dancing on the graves of anyone with a negative opinion. But all of a sudden, it's starting to feel like the news cycle is turning more negative. There are problems in China, problems in the option market, billionaires coming out and saying that both bonds and stocks are overvalued and actually using data and metrics to prove it. The kind of stuff that Mike McGlone probably really likes. And speaking of Mike McGlone, we have him and Dave Weisberger, and now a fourth guest who's going to be joining us hopefully every week or most weeks if we can get him up on the West Coast, James Lavish, who's been very, very popular with you guys. I know you'll be excited to have him here. We have a lot to talk about today, especially after taking an entire week off. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of All Streets. Before we get started, please subscribe to the channel and hit the like button. As you guys know, I was off the last week. I was in the Cayman Islands actually with the family, but regardless of vacation, I always take that last week off before my kids go back to school to spend time with them before the mayhem of the school year starts. But the highlight, don't tell my family this, but the highlight was that I actually got to sit down and have dinner with Raoul Paul. We had one or two too many drinks and talked about markets, the world. It was really awesome. We had a great time. It was great to finally put a face to a name. And he continued the trend of everybody that I meet seemingly in person is way taller than me. The guy is like 6'4". He looks like he could play professional basketball. He's absolutely huge. And I looked like basically a dwarf standing next to him. But let's actually go ahead and talk about markets. We'll have the public conversation outside the private one I had with him. I'm sure Dave will be joining soon, but we've got Mike and James here already. James, it's dark over there. I know we get you up again. I'm sorry. I say it every time, but
that's all right. That's going to get bright here soon. So
I imagine it will. So listen, right before we started the stream, obviously we have some data showing that Bitcoin likely might be undervalued. We'll see. And we have quite a bit of data that stocks and bonds are overvalued. We're going to talk about that and we'll get to it. But also, you pointed out some bad news coming out of China, and that seems to be pretty consistent. This is China finance giants miss payments, alarm regulators, markets. Zhongji, we're going to call it that because we don't speak Chinese here. But Zhongji Enterprise Group, a secretive financial conglomerate that manages about $1 trillion yuan, surged to the fore after several of its corporate clients disclosed overdue payments by a trust unit. And they're saying this is a property crisis has spread to the 2.9 trillion trust industry. Mike, does this matter?
Oh yeah, it's unfortunately, it's a tree in the forest, and those trees are getting more significant every day. So that's just the latest of what I see as a train wreck, imploding, resetting economy. I don't say these things lightly. I don't wish bad things on anyone, but it's my job as a strategist to point out my views, undeterred by other people's views. And another headline I just saw on the Bloomberg Terminal, it says 3 trillion reasons the trust industry shock is not over. That's the trust industry. But the key thing to remember is that, and on a Bloomberg headline, you can't put a journalist's name, because this has happened to us. People, my colleagues, can get detained for quote unquote detained up to a year if you write the truth about what you think. That to me is the macro what's happening. I view China as early days of something similar to what we saw peak Japan when the Nikkei peaked around 40,000, and it's still below that level, and 30 years ago, and peak China and peak Soviet Union. I like to, and every data you see is just the exact opposite of what we saw in the beginning of the year. So it was only 8 months ago. So maybe it's leaning too far to the pessimistic side. But I ask myself, is what's going to stop this? Remember, what's happening now is the reshoring, onshoring, and get out of China mode is accelerating. U.S. now imports more from Mexico than it does from China for the first time in 20 years. Where the Chinese leader, one leader, it's not China anymore, it's one person. That's so significant. Even there in the Soviet Union, you had some checks and balances. They don't even have those anymore. And he is completely upset his top customers. The U.S. is one of them, but Europe. So I see things as just a normal correction in an economy that grew too far too fast, and it's now set the country that brought it out from being mostly country of peasants. So in the macro, what I see here is it's August, and yeah, we're seeing the little flows in markets, but to me, this is really going to accelerate into what I view as one of the biggest resets of our lifetimes. China in decline, that's way overdue and normal. I look at commodities right now. Crude oil's just had its bounce and it should go lower. That's normal. Copper's starting to tilt back down. And the number one factor is the stock market has to stay up or else everything trickles down. Housing, yields, interest rates. And still, the problem is that in my lifetime, I've never really seen is even if it drops at say 10% from here, which is not supposed to matter, the Fed is still not going to ease. They might start pricing for it because the metrics they watch, personal consumption, expenditures, employment cost indexes, will stay sticky. But some of the key things I liked, like PPI, just dropped at its fastest pace in history, and it's starting to bounce a little bit. Back to you,
James. What do you think?
Yeah, I mean, China has they have a housing issue because the Chinese people, their savings it's in real estate. Right, they don't have like 401ks and IRAs. They save their money in real estates, and these trusts, like the one that missed the payments this morning. Neither can I pronounce what the actual name, but it's
Going with Zhangji.
Shangji. So
That's what we're going with.
Yeah, I just don't want to butcher it. So, but they miss payments. The thing is, they call it the shadow banking industry there. So we don't really know what's going on. And like Mike said, you can't really report on it truthfully, or else you could be detained. So that's the issue here: is that how big does this get, and what kind of contagion is it, and does it spread outside of China? And that's a likely yes. And so it's a question of how, when does that next domino fall? To knock something into that contagion crisis kind of category. And so that's what we're watching for. And it does worry me because that they have so much leverage tied up in the real estate market that missing payments because of the way that they were investing. They were investing in unfinished real estate units that they were expecting to to get filled up and pay back some of that principal. That's the problem. So
yeah, I haven't dug into it that deep, but you see these, or over the years, you've seen these images of full cities that they've effectively built just to show whether you think they thought they were going to be filled or it was just artificial growth, right? Effectively stimulus, but millions and millions of units in these towns that not a single person has ever moved into.
Exactly.
I mean, Dave, is that cooking the books? I mean, is that what's happening in China and finally it's coming due?
Well, yes and no. I mean, cooking the books for sure. Coming due. I mean, what will actually happen? I mean, James, who I love many of your threads, but the way I look at this, I'm bemused by it. I think that the federal government in this country and in a lot of countries, but certainly in the Western world outside of Germany, are entering debt spirals. We don't have the money. There is literally no way to pay back the debt if you take in unfunded liabilities in Medicare and Social Security in this country. It's literally impossible without one thing. The one thing is inflation. Now, what kind of inflation do we need? And I've said this for years. People need to keep missing the boat. Inflation. I despite going to Northwestern, I believe in the Chicago school. We get that. Okay, inflation is a monetary phenomenon. So what kind of inflation? We've had raging inflation for 30 years, but it's all been in assets. And asset inflation is exactly what the government needs, because the only way they're going to pay back this debt is for the economy to grow in nominal terms, for assets to go up in value, and people to be continuing buying treasuries. Mortgage rates in this country hitting 8% is a big freaking deal. And there is no way of think about that for a heartbeat. So now we have mortgage rate at 8% and the long bond at what? 4, give or take? Is that sustainable? What happens?
4.16. Yeah, I think.
Sure. What happens if the long bond goes to historical averages in the 6.5 to 7 range? And what's our debt? James, you tell us.
The deficit grows by so much.
There's no way out. So now ask yourself the question. Mike is convinced the Fed's going to fight inflation. I'm calling bullshit. The Fed can't fight inflation when they actually want inflation. They just don't want consumer inflation. And they absolutely need the long bond to stay here or go lower. They can't afford it to keep creeping up. And they're going to use what's going on in China and the contagion as an excuse for sure. And the real issue is, how do they do this at the same time as restraining CPI? Already, you're seeing the lapdogs of this administration out this weekend starting to talk about various forms of price controls. You're already seeing it. And, you're going to see more of it. It doesn't work, and it will never work. And it's amusing how people keep thinking that, we've had 5,000 years of human history, and never once has a central planner ever been able to set prices in a way that's worked, but they're going to keep trying. I just look at all this stuff and I think, look, follow the money. The Fed can't afford the long rates to go that much higher. And I just think that that's where the things break. So they're hoping to break inflation and then be able to get back to what they were doing. And as James reports on very well, I just don't see how they can. I mean, I'm curious what you think. I've been looking forward to this ever since I saw the tweets you were joining us, James, because I know you have an opinion on this.
I do. Look, our interest payments are up almost 50% year over year on the debt, at the federal level. It's inconceivable for everybody who the Treasury puts out reports regularly. And what they do is they're telling you what they expect to happen. It's always a pretty optimistic report, in my opinion. They never expect a recession. They never expect a long period of increased rates. But you've got interest payments on treasuries now they're reaching about $1 trillion annually, and so it's more. We're going to pay more on interest on our debt than we're going to pay for military spending in this country this year,
which needs to come down about 50% itself. But yes,
so you're talking about $850 billion of defense spending that we know of, right? And then you've got almost $1 trillion of interest payments. And we through the whole debt ceiling crisis, we drew down the Treasury general account, and we ended up having to refill it with $1 trillion, right? So how do you do that? How do you fill up? Well, we've been sucking money out of the reverse repo facility, and so we've taken Mike, about $600 billion out of that, something to that effect. And so it's gone from like 2.3 to 1.7 ish last time I looked. And so, where else can you go? There's only so much you can take out of that. And then, so the Treasury just keeps issuing short-term debt that's expiring in a month or 2 months or 3. And so it just keeps they have to re-up. And at some point here, they have to issue longer dated treasuries. And that's where interest rates start to move on the long end. So you get the 10-year moves and the 20-year and 30-year. And now you're seeing mortgage rates up over 8%. And because what happens is, and you sent Scott, you sent
this Twitter thread.
From Conca, and this is a great thread. And I agree 100% is that cash has to come out, money has to come out of risk assets to meet that demand, that treasury demand for longer dated paper. And so that just means that it's going to be a little bit of a crack on risk assets. So these things all add up, like Mike said, and Dave, you're saying it's just there are trees, there are signals, they're stop signs, and we're just kind of blowing right through them. And what worries me, what has worried me up to now and still, is that we have some sort of credit event. You can't raise interest rates 500 basis points in a year, which is it's over 20 times what the interest rates were at 0.25%. So you can't just raise them that much without expecting something to break. And it did. We saw what happened in Silicon Valley. But I don't think that's the only thing. There's something there. There are other things out there. There are other companies or other, either whether it's an insurance company, whether it's another bank. There are other institutions out there that have this interest rate risk that it's not going away, and they're making the bet that they get through this. They kind of step through this field of landmines, and they get through it okay. But the rates staying up here for another few months, again, either 3 months, 6 months, 9 months, something's going to break here, and the Fed's going to have to swoop in. And that's, so you're watching the risk assets gauge that and wait and see, can we actually soft land? You know, do we have
that means
soft land? So there's a lot of push and pull. For me, it's just one of the most difficult markets to gauge that I've seen.
I mean, Mike, I'm going to let you go 1 second. I just, in layman's terms, basically that means stocks should be topping, right? Which I think that Mike's been saying this whole time. But the gist there is that when the Treasury was effectively releasing these shorter term duration, people viewed them as risk free. As they become longer duration, people don't view them as risk free, and to hedge, they have to actually sell things and match risk assets.
I use short term. I use short term bills to, instead of cash, in lieu of cash, because they're yielding so much. Yeah. But I'm not buying long dated paper. No way.
Right. So the risk is not the same. So that means that people have to hedge, use cash, which sucks liquidity. Basically, they've been saying that they're doing QT for all this time, but the QT is really just starting because they've had all of these sort of low key behind the scenes quantitative easing happening with the bank facilities and reverse repo and all these things. Is that the gist?
Yeah. And we're, all this is happening. Exactly. 100%. And all this is happening at our favorite time of year, which is coming right before window dressing season. Right. And so as Mike and Dave know very well, this is when we get sell-offs, September and October, period. And here we are. And everybody's just like, it just baffles me that we do this every time, but here we are.
I look at this as one of the most straightforward asset allocation environments ever. The U.S. government 2-year note gives you 5% approximate right now. Okay, talk to you later. Call you from the beach or retirement. And to me, you're supposed to look back and say, okay, I do think that's just logical, historical. The S&P 500 is supposed to get closer to 3. It's 44 right now, 4.4 or 4,500. It's just normal. What we described is a train wreck that has to happen. And then you look at, on an international basis, U.S., okay, in the 2-year note, you get around 5%. In China, you're getting 2%. Well, good luck with that one. Not much happening there. In Japan, you get nothing, maybe a couple basis points. In Germany, the third largest economy, you get 3%. You're still getting 200 basis points more in the U.S. And in England, you get about the same. What's the safest asset in the planet? It's still U.S. Treasuries. You're going to get those dollars back. And then, of course, you have 11 aircraft carrier battle groups protecting you. So I look at this as that environment about debt. Heard it, seen it, and I just lived with it from 30, 40 years ago when I was trading U.S. Treasuries. It's just so mute. We're all turning Japanese. But that's, to me, the credit event will come and almost never don't. They always happen. You have to have risk assets go down, and they've gone up. So you take out the tide a little bit, and then you see who's not wearing clothes. And to me, that's where we're heading. And that's the key question I ask is what stops this? So what we're doing now is the greatest rug pull in liquidity ever after the biggest pump in liquidity ever. And the fact that I can say that and show the data is still shocking to me. I can go back and give you examples from the 1920s when the U.S. created massive supply of liquidity and they shouldn't have. So money supply is still negative. PPI year over year is still negative, and the Fed is still hiking rates and price for that. So I look at it as everything else is going to trickle down from that, and the Fed's not going to stop. They will. I fully expect yields, bond yields, everything to drop after the stock market does, and the question is what stops it. It's all trickling there. So we on our call this morning, even our main economist said, yes, they've been early, they've been a little bit wrong, but they're still maintaining the year-end recession view. So let's picture ourselves in December. Recession's kicking in. People are hoping the Fed will ease, and they'll probably get up and say, no, we're not, because we still see high inflation. That's something we haven't seen in a while. That's the great reset, I think, happening in early days. And then you tilt over to what should be early indications of that. What was the biggest liquidity pump indicator, new technology ever for the last 10 years? Cryptos. The best indication should be Bitcoin. And that's where I'm looking for the lead indication from Bitcoin. And it's still kind of showing what I expected. It got up to near 30. And it's just not been able to get much above there. At some point, Dave was going to go. At some point, that's going to change. I know. But right now,
it's a stable coin. I mean,
I've been laughing. I was going to say, right. I'm laughing. Not only can it not get above 30, it can't move $200 in a week.
That's significant. That's the key thing. That's what I really pointed out writing this. So Bitcoin has become a stable coin, and stable coins are clearly globally becoming crypto dollars. And that's what I loved writing about that when Fitch downgraded US debt. If you use the S&P when they downgraded US debt in 2011, that was a great time to buy the dollar. The trade weighted dollar index is up 40% since then. Every asset in the US on a trade weighted basis is up 40% versus every other asset in the planet since that downgrade. So I look at it as, thank you for pointing out the obvious. Thank you for pointing out how strong we are, because we're debating in this and facing this. You can't do that in China, in Russia.
The dollar's pumping. Yeah.
I mean, look, there's a lot to unpack there. First of all, Bitcoin is far from a stable coin. Bitcoin is
This week.
Well,
Come on, Dave. We zoom in
Most
here.
volatility ever.
It is the lowest volatility it's ever had
Have you
in
ever
history.
heard the expression "rock in a hard place"? So you have people. It doesn't take much. The market size of Bitcoin is tiny compared to the investors who have professed interest in it. We have two huge news events that have not happened that people are waiting for. One negative, one positive. Negative is Binance, which is, I don't know, 40% of global liquidity in crypto, going to get shut down by the DOJ and Interpol. And the other is, are we going to get BlackRock and Fidelity's Bitcoin ETFs approved, which unlocks double-digit trillions of dollars potentially, and almost certainly at least the current market cap of Bitcoin in demand for Bitcoin. I mean, at least that within a year, which takes Bitcoin. There's just simply no way. There's not enough sellers with 70+% of Bitcoin as people who believe it should be worth $250,000 or more. You're not going to see a lot of. It's going to take a lot to get that demand. That demand will come in slowly. It won't be easy. It's not going to be a straight line, but that's a big deal. And so you have this rock in a hard place. You have people who are willing to accumulate dips, and you have the speculators are finally exhausted. So we have tops in a normal asset. You would look at Bitcoin and say, well, look, when do tops happen? Tops happen when the long speculators get exhausted and the buyers aren't there. Well, that's not what's happened in Bitcoin. What's happened is the long speculators are exhausted because every time they get there, and I am going to use Mike's word because I love it, every time their hopium gets to certain levels and they inject the hopium into their bloodstream and they start pushing it past 30 to 31, within minutes, they look around. It's like Wile E. Coyote. You run, and hope for other people behind you. And you look around and there's nobody there. And it's like the puff of the smoke cloud goes away and all of a sudden you start falling. But of course, what does it do? It falls right back into the current level where there are long-term buyers who are willing to DCA into it. And so that's why volatility has gotten low, because there's zero long-term, positive speculation. When there's zero positive speculation, that is when rallies start. So, you have this dynamic going on in Bitcoin, and the dynamic in Bitcoin is literally the polar opposite. The macro that we're talking about for, quote, risk assets is exactly what Bitcoin was designed for. Almost everybody who owns it in those 70% of all Bitcoins that are being held are holding it because they think that dollars, yen, euros, renminbi, all these pieces of paper, these governments are going to have to competitively devalue and print their way out of a debt crisis that they literally have no other way to get out of. And so that is interesting. Now, sure, on the margin, do you expect the correlation on the downside? Look, if there is a massive stock market sell-off and we do get a crash in the fourth quarter or the third quarter, I think that Bitcoin's beta, it will be historically low, just like volatility is historically low. Why?
It has been. Yeah.
Well, because there's no speculation. The reason Bitcoin's beta is high is because of all the speculation that's been going on, and there isn't any right now.
There's also no liquidity. I mean, to the point of the tightening, there's just zero liquidity, and where's that going to come from?
Well, be careful, Scott. I mean, we track this. We track this extremely well. And the liquidity is real. It's just liquidity has left the U.S. dollar pairs. I mean, would it surprise you? I mean, I don't know if I can. I have some interesting charts that I could show, but at the end of the day, I'm looking at the cost of $1 million of Bitcoin liquidity in the market, and the cost for, if you go back 6 months for dollar pairs, Bitcoin dollar on the Bitcoin dollar exchanges, it was pretty much between 4 and 6 basis points for $1 million. It's been very volatile over the last few months. Now it's kind of at 5, give or take. The Bitcoin Tether pair liquidity, on the other hand, is very different. It's half that. The liquidity is moving offshore, which is not terribly surprising. And so, there's a demonstrable, we're actually writing a paper for the Journal of Investing on this. And I'm going to talk about this in our midsummer recap. But the fact is, liquidity in the markets, the reason people are willing to buy Tether, get no yield, is because they want to be able to trade crypto. And it's global and it's big and there's demand for it. Those crypto dollars, the reason for those crypto dollars are because the direct result of the U.S. authorities cutting off crypto firms from the banking system. And so, we're seeing very interesting, cross currents going on here. But be careful when you talk about liquidity, because liquidity is there. It's just not there for, it's just there's no people doing really dumbass trades. And the reason you get seriously, I mean, there are people fewer. No.
Have you seen Friendtech and Pepe lately? Yeah.
No, I know you're right. You saw XRP on Gemini last week.
Yeah,
about that
went to $50.
I mean, people in crypto. I mean, look, my whole company is based on trying to help people execute better, right? Here's another fun fact for you. Bloomberg produced and I asked Larry Tabb for this, a thing that talked about U.S. equities versus foreign equities, the cost for institutional orders, and they showed the cost to buy cost to buy less than 5% ADV, average daily volume, for U.S. equities around 11.5 basis points, whereas in Europe and the UK it's like 7.5. Everyone's like, "Ooh, the U.S. the greatest capital markets in the world." Well, not anymore, and there's a reason for that. There are lots of reasons for that, but what's interesting is the U.S. is overregulated and under, intellectual. But here's the fact that no one knows: our clients, COINROUTES clients, since January through the end of July, their cost for $200,000 orders or more across crypto, is under 7 basis points. So actually, this deregulated Wild West market of crypto, it's actually cheaper to do institutional size, even in the U.S., even including all these volatility issues. It's actually cheaper if you trade intelligently. Now, part of the reason for that is our clients benefit from other people's stupidity. I get that. So it's not necessarily a market-wide phenomenon, but it is important to understand all this. So be really careful when you talk about liquidity. What's happening is, there is not enough liquidity for a major buyer. So if there was a major buyer did an asset allocation towards Bitcoin, its price is going to go up because there's supply and demand. But liquidity for short-term trades and for people who are in the ecosystem, it's actually fine. It's just in the U.S. that it's been a disaster. Sorry, that was a very long-winded rant. I'm sorry about that.
No, it's not a bad thing at all. You're allowed. And I wanted to go just circling back specifically to talking about really what James was talking about, Dave, you as well, that treasuries effectively have to go up. One of the reasons that we said stocks and bonds are overvalued in the title here is Bill Gross, the long bond, known as the bond king in the past, was a co-founder of PIMCO. He says that 10-year treasuries and that stocks are both overvalued. We're at 4.16%. He says 4.5% is fair. How much would that, I mean, that's almost a 10% increase, right? It seems like it's not much, but how much would that rock the market if it actually even just rose to that level, James? We're talking about 6, 7, 8%, but how much would it change from 4.16 to 4.5% matter in the current environment?
Remember, you're talking about a piece of paper that has a number of years of duration, right? So that kind of multiplies that effect. So it also depends on how quickly you got there. If it happened in a day, it would destroy markets. If it happened in a couple of months, I mean, it would just stair step it. So it really, really matters on how you get there, right? So, but it's a huge move, and that's right, they are overvalued, and that's the concern. Is that where is all this capital going to come from that's going to fund these massive deficits? Where's it going to come from? And so,
there's only one way, it's printing, but we've made the argument here.
Before that, it's got to come out of risk assets, right?
Right, exactly right, which is that entire thread. But Mike, like you've often made the point here that the days of easy liquidity are over. the government does not pivot back to the same sort of aggressive QE and printing that we've seen in the past. James might disagree, so this could be a good conversation.
Yeah,
but where is it going to come from if they're not going to do that, Mike? I mean, we know that it will short term, it will come from risk assets, but eventually those sell off. If you have a crash, there's nothing left to sell. Where does it come from?
Well, that to me is, I think the key thing we need to look forward to is, unfortunately, is there's plenty of times in history money just leaves the system and you just poof, it goes away. And that's what I think is going to happen in the equity market. Remember, we've had this, it's really been since the low in 2009. But what's changed, the key thing is also that's helped boost the equity market to highest levels ever versus housing, versus GDP, versus sales, you name it. And versus the rest of the world, the U.S. stock market. That to me is where it's the train wreck I see happening. Is the Fed's not going to be there to save the equity market. And right now, it's doing the equity investors a favor, particularly people who are retired in Florida. Turn off CNBC, stop trading stocks. I mean, it's the biggest casino in the world, and just put your assets into these treasuries that the government has pumped up to these high yields. When you get to that deflationary trajectory, I didn't say if, because it always has happened that way. You get deflation after these type of events and this type of action, and particularly now we're in an environment where we're in the most, in terms of technology pushing prices down, one of the most deflationary environments ever. Book of Price Tomorrow by Jeff Booth, Super Abundance, another book I've read. They're all tilting that way. To me, that's what's going to happen. Is the Fed's not going to save you the first move, that first 20%, 50% down, and then it gets over to potential depressionary levels. That's what I'm afraid of. The key thing is right now, that's the current trajectory. We've had the bounce. We know the Fed's not going to save us. The market's still living this hopium, which is not my word. I stole from someone else, I think, on your program, but I appreciate
the classic crypto term. You know.
So thanks for the mention, David. It's a classic crypto, but it's great. I love mentioning that with people. Like you mentioned boomer rocks to people in gold conference. They had no idea. I'm like, you didn't know what a boomer rock was? Okay, but back to the key things. That's the scenario I think we're going to. That's my base case. It's been my base case for over a year. I know it's early, it's been wrong, but it's tilting that way. I can show you it's happening in commodities, it's happening in inverted curve, leading into economic indicators still at -8%. You look at the potential for recession from the New York Fed's probability recession from the yield curve. It's the highest since 1982. Great, maybe that stuff doesn't matter. But then you have to put this in the context of rational human nature and economics and history. What we've done is distorted all the models. And now we're going back to normalization. And I think we're going back to that world where bad news is going to be bad news and good news is going to be good news. It's going to take a while for that transition.
But Mike, we haven't done this for how many years has it been since we've had 130% debt to GDP, right? So the leverage in the system is so great. What concerns me, it's not as much. Okay, so it's like landing that plane, right? Where you gradually take that, you decompress that cabin, right? So you can take oxygen out of the room. But if you have a credit event, which I would liken to one of the windows popping out of the airplane at altitude, you've got to drop the oxygen masks. There's absolutely no choice. And so we saw it happen just a few months ago, and everybody's just shrugging off the bank failures that are happening, like the one that happened in Kansas last week. They're just like, it's just
didn't even happen. It's like it didn't even happen.
It's just another bank, no worries. But if when we have some other credit event, I don't know what it's going to be. I cannot call it, but I strongly believe that we have a very high risk of another credit event because of just the nature of how quickly we have skyrocketed rates, and we haven't seen the effects yet. And so, yeah, so that's where I think the Fed they have no choice. The Fed and the Treasury have to rush in and stabilize the market, because what they cannot have is the Treasury market become illiquid. If that happens, the entire system falls. So we have to keep the Treasury market liquid. And that's when that money printing occurs, because they have to monetize their own debt in order to keep that engine going.
So that is something we should look forward to as a potential iteration. I completely agree. Remember, we have good example for what's happening. We're all turning Japanese. Now we kind of got away from that short term, but we're all going back there. But I have to just, one thing I did appreciate a column that was written by my colleague Niall Ferguson this week. And the economy is not a plane, it won't land gently. And I just wanted to use that because people use that landing analogy. I love it, but this is why I think I agree with you, but that's what's happening. We're going to, I think it's just a matter of time we get a reset in risk assets that have gone up and created an exceptional amount of wealth and inflation, and then the Fed will save us, but not in the pace they have. The point is, we're not there yet. We're still in that point. We need to see that happen. And that's why I look at it. That's why I say, just there's certain times in life you're supposed to say thank you, U.S. government, too, and good luck. People invest overweight the stock market.
I mean, we're still 1,000 off the S&P lows, though, right? I mean, it was, what was it, last September, October? Yeah, last October, we were at like 30, just sub 3,500 on SPX. Still at 4,450.
Maybe that was a shot across the bow. That's the way I look at it. This is things, how things have happened in history. And it's also the things that we all remember with markets. And yes, I use 1930 as a good example. You had to have that big bounce, but it also, we all know human nature. You got to get people with that hopium and then give up. And I think we're going to have the period I've seen only twice in my career. I'm only almost 60, where you have to have that elongated period of people give up and you read headlines that it's no longer a place to invest in the stock market. At some point, that always comes. I have to ask ourselves is, when is that going to be? To me, this environment is one of the best ever. Fed's still tightening and the back of liquidity is still plunging. The whole world's tilting towards recession. What stops it?
I'm looking at I just happened to bring this chart up because you were mentioning 1930. It's a chart I'd made a long time ago, but it's Dow Jones basically showing what a blip every single panic or crisis has ever been. When you look at it, even the Great Depression looks like a blip. But when you look here, I mean, COVID, it's like it didn't happen, of course, but seeing where we are now, how little effect we've had to the downside on the stock market of any of this, even relative to these other ones, it's scary. Nothing's happened yet. When you look at it like, zooming out, these are years. Each of these candles, nothing's happened.
Normal reversion of an excessive, extended asset appreciation period on the back of liquidity. When that liquidity goes away is what happens. Almost every example in history. It's just a question of when. And like we discussed, it's credit event's going to happen, but it typically takes the tide to go out a little.
Yeah, 100%. Absolutely. That's a great point, is that it takes risk assets being repriced at least, whatever it is, 5, 10%, 10 to 15% before something does, before the emperor has no clothes and it's revealed, right?
I mean, the real crash comes after the pivot anyways. Historically.
Historically, that's right. So that's
everybody's so excited that they might pivot, but that's when the real crash comes.
Here's the interesting part: is that all this timing is it's mind-boggling, right? So here we are heading into the window dressing season. For your listeners who don't know what that is, it's the asset managers and investment managers. They dress up their books to realize their profits for the year and their P&L, so they can get paid on it. And it typically happens, to get their bonus. It typically happens. It's in September, and they want to get losers off the books because they don't want to have the tough conversations at the end of the year. Why do we still hold this? And so that's where you have repricing typically in equities, but it's all happening right as the Fed's about to not necessarily pivot, but once they pause, that's a signal that they're worried that rates are high enough above that neutral rate, which is it's contractionary, right? So if it's above a certain rate, they feel like it's contracting the economy or it's pressuring the economy to contract. And so once they get to that point, they're signaling we're there, and now we're going to hold here for a while, and right as we head into the fall.
Yeah, so you guys, we've got some ex-hedge fund managers, traders here. Mike describes, obviously, the low risk of just being in short-term treasuries right now. Why wouldn't every hedge fund just make their 5% on the year by sitting in treasuries and just have nothing to do with any of this?
Because if they do and the S&P goes up 6%, then
it's the reputational risk of missing out. Yes, but
I mean, look, at the end of the day,
But hey, hedge funds are supposed to underperform in a good market, right? Isn't that what's supposed to happen? When things go up, hedge funds are supposed to do a bit worse, but when things go down, they're supposed to protect your ass. I mean,
absolute return.
Well, but the absolute return is benchmarked to the risk-free rate. So, And if you want to get your
Right.
20 or your
5% is a zero.
yeah, it's problematic. But I mean, look, at the end of the day, the fact is that we have a bunch of two huge cross currents here. We have what we believe in nominal terms is overvalued assets. The one thing I would point out on your chart, Scott, is if you do the exact same chart but divide it by the purchasing power measured by any reasonable measure of inflation.
Adjusted for inflation.
Yeah, but not necessarily the inflation that we've manipulated. Do it the way we used to measure inflation. If you just go on Shadow Stats, shadowstats.com, and look at the difference between inflation. Yeah, a guy named John Williams founded it. It basically, the CPI has been adjusted a couple of times. A couple big ones. The way it was in the 80s, the way it was in the 90s, the way it was even earlier this year. They keep doing things like substitution effects and all sorts of things. Real CPI is much higher than the actual CPI, which explains why, by the way, every human being that's looking at their bills, if you're not, you can't eat your TVs, your calculators.
3% my ass.
Yeah, that's the point. Like, so you're hearing people, they're upset, they're frustrated, they're angry. They know they're being lied to. They know. They're like, inflation's not 3 or 4%. You cannot tell me that your grocery bill is up 3% from last year. Come on.
It's just not possible. It's everything that is, at the end of the day, anything that you buy, whether it's a good or a service, that capital couldn't substitute for labor, that you can't offshore instead of onshore, that technology isn't driving the cost down. Because Mike is right. We have in technology has been hugely deflationary, and it's allowed us to have this massive inflation in asset prices for the better part of 40 years. And people, it's this dogmatic looking at one. It's like basically trying to capture a three-dimensional space with like a line graph. You can't do it. It's not even a two-dimensional picture. We're talking about a line. We're talking about looking at one point or one thing.
But Dave, isn't that the whole point? Is to just bamboozle everybody, including all of our international investors in our bonds, to believe that inflation's not bad, it's okay, and then quietly inflate away that debt by allowing there to be long-term higher structural inflation, which is what Mike was talking about. And I agree, right? It's their only way out of this high long-term inflation.
Exactly my point. Thank you.
So let's bring something in on that. And from a commodity standpoint, I really enjoy when people get bullish commodities when they go up, because the rule in commodities is you're supposed to sell them when they go up. And because that's just a fact. Crude oil price right now, you see on the screen, was first traded in about 2007. So let's look at the 3 C's of commodities: crude oil, corn, and copper. All of them have, the first time they traded these levels was over 10 years ago, almost 15 years ago. So there's clearly signs of deflation. I published recently is the only thing that makes things go up is you overlay all these assets with money supply, as Dave points all the time, that big pump we had of money supply during COVID, that's going away. So I like to point out, yes, a lot of these things have changed for CPI, but if you just look at it, raw commodities, what you eat and what you use for fuel, the actual core price of that commodity goes down every day, which I like to tilt over. People call me McGlone. I say, well, that's why I'm so bearish in commodities, because of human innovation, but so bullish on the companies that create those. They can do more in every day. So I'll just give you a little hint. I just came back from the Corn Belt. Every time I go out there, I meet with some people I know and who are farmers and produce. They say the same thing everywhere. The technology is going so fast, I can't keep up.
Right. Now, but think about what you just said, because it's really important. You mentioned the 3 C's. I mean, copper, yeah, sure, fiber optics have taken some of the demand for copper out of wiring, but the reality, copper, I don't know what the mining technology is. But crude oil, we had one of the biggest single events in the history of crude oil production called fracking, which made us dramatically cheaper to get oil out of the ground. We had the one when it comes to corn. I mean, just forget about it. I mean, you're right. That technology, there's too much of it, not just GMOs and farming and better fertilizers and whatever. Those are massively deflationary to the price of that in real and nominal terms. It's so strong in real terms that it's in nominal terms. The issue is a lot of if you think about, go back what the government wants and what James was just saying, the government wants inflation in financial assets, and what they don't want is inflation to creep into people's demands for wages and inflationary expectations. I mean, Powell talks about this. Just listen to him. He understands this. I mean, you know, I give him a lot of props. He's done a great job given that fact, but he cares about people's inflationary expectations. That he loves the fact that technology is bringing down oil prices. Of course, it's also using the Strategic Petroleum Reserve also brought down oil prices, but
Strategic midterm reserve.
Go there. You know, it's like there's a lot of things going on, but that's what he cares about. I mean, if he could do what he's done, and James, you weren't on this, but I used to do this all the time. Say musicians learn, you distract the audience, look at this hand and all the real stuff happening back here.
That's right.
He wants people to be looking at nominal inflation on things that technology is driving down, while he pumps the economy up here and pumps up asset prices and helps make the long debt more sustainable. That's what they want. Whether they can do it or not is a different story.
But the argument here from that thread and what we were mentioning before is that the Fed has basically, maybe they don't, but there's effectively run out of bullets, and it's really the Treasury that we need to look at for what's happening with liquidity and not the Fed.
Right. Well, go back to what Dave was saying before we even get to that. Another thing that has impacted crude prices is we've drawn down the Strategic Petroleum Reserve by hundreds of millions of barrels. So you can't ignore that. Like the fracking plus that it is impacting those prices, right? So when does that turn? That's another impact that we're not even discussing. There's a floor there for the U.S. to refill those reserves. So
don't need it anymore. So I appreciate you going there. I did write a piece about a year ago when a friend of mine, Jeff Curry, was so bullish in commodities, and I wrote Facts and Fantasies of Crude Oil. And that is, we don't need an SPR anymore, because the only reason we really need it is for hurricanes, because we have a massive excess of supply. We need less. And here's two statistics. One, first of all, unleaded gas consumption just recently is about 5% less than it was before COVID. Okay, so we know what's happening there. That trend in unleaded gas consumption in this country peaked years ago.
Work from home.
Not only that, but efficiency.
Mm-hmm.
EV sales on a global scale are now about 15% total new car sales. Before COVID, it was around 3%. What accelerated that? This little invasion. Who supported that invasion? Unlimited friendship. That, to me, is all that big picture kicking in and just accelerating the technology. So I look at it as, I like how, yes, I like to say President Biden might go down in history as one of the best crude oil traders ever. And I also pointed out, you're supposed to sell your inventory when you're in backwardation. You buy back futures. Now, you haven't bought back the futures yet, but that's just normal inventory management. But now it's just not needed, particularly if you include Canada, and all that crude oil up north gets kind of locked down and stuck in the US with pipeline issues. We're running excess of 4 million barrels a day of crude oil. That's 4% of global supply. That makes, that's probably, what is that, a third of Saudi Arabia's total crude oil production.
Right. We don't know how much of the reserves are actually usable too, right? Because they're sloshed around the bottom of these tanks, and we don't know how much is actually usable. So, but what's that, Dave?
I said salt domes.
Exactly. Sorry, Scott, go ahead. Yeah.
No, I was going to actually ask you guys, because this is, I guess, sort of breaking. If anyone's following what's happening in Argentina, there's been an election surprise. And I just read Argentine peso plunges 18%. There's like in a matter of hours after election surprise. Yesterday, because the only market open was crypto, obviously, Tether was trading at an insane, like 15% premium in a matter of an hour for people rushing into Tether. But basically, this is a huge shift, it says, in policy, as President Alberto Fernandez's government has held the exchange rate steady through a web of capital controls, price freezes, and exchange restrictions. And now kind of all bets are off. I think the guy who's surprising is a libertarian. Actually, I've heard he's potentially a Bitcoiner. Not that that's relevant here. But, I mean, it seems to be cracks all over the place here.
I mean, look, at the end of the day, everyone in the United States who hold on to boomer rocks as opposed to new boomer, as opposed to, a new digital form of money, ignores how important having sound money is, and ignores how bad it is to be in a place where the currency is there. If you end up with a libertarian in a place like Argentina, Argentina is a bit larger than El Salvador. Imagine what happens to the price of Bitcoin if Argentina goes the way of El Salvador.
Imagine what happens to this president if he's actually a Bitcoiner and gets in control in Argentina and the IMF gets wind of it.
Well, the IMF basically, Bukele or whoever
IMF.
It told the IMF to pound sand. Eventually, people are going to realize in these countries that the IMF.
El Salvador could tell the IMF to pound sand because the dollar is their currency.
Right.
Right. Yeah, that's harder to do when your currency is the peso and is already hyperinflating. But
that's right. No, I'm just. But look, the bottom line is that austerity is not the way forward for these countries. The way forward is to actually unleash the economy, and we've seen it. I mean, look, we've seen it so many times over the course of the last 60 years. I mean, all these people in our schools who are learning that 57% who think socialism is better than capitalism. Look at this. Now they're doing it because they're looking at our system, which is more cronyist than capitalist. But the fact is, the only way forward for these countries is free markets. We know it, and they'll figure it out eventually. Every single time they end up becoming debt slaves, they get nowhere. It's like the only countries that succeed at being debt slaves and getting where, the only one I know of that's actually gotten anywhere is Greece. And why? It's because basically Europe
austerity.
No, because Europe is carrying them, because the Germans are subsidizing the Greeks. That's what's happening, because the Germans
place to go for vacation.
Exactly.
Germany's subsidizing.
I know, get Greece off the euro, and we can go on really cheap vacations to the islands again.
Really?
Yeah, but listen, I know we only got like 7 or 8 minutes left, and I do want to talk about Bitcoin, obviously, and get an opinion, because we know, Mike, I know where you stand, and we'll talk about it, but obviously that it's been sort of a leading indicator. It's been stale, likely to obviously crash. Dave, you haven't made an opinion on when, but believe, which we all do, that it could clearly untether, and it could be decoupled and perform differently. We have it in the title, Bitcoin Pump Ahead. I just want to show you guys that was based on this article. Matrix Ports Bitcoin Greed and Fear Index indicates upswing ahead. It's historically been accurate, blah, blah, blah. But yeah, we know that these indicators don't matter that much. James, I want to ask you first, do you think that if we get this great reset, that we see this major correction in stocks, that Bitcoin could either stay where it is or go up in that environment?
I think that, all assets correlate to one when we have, if you have a credit event or you have a strong market sell-off, strong market move, that's just reality. But I do believe that Bitcoin does decouple from that bottom, and it leads the way forward back up.
2020.
I do believe that exactly. And
Bitcoin went up 17 times from the lows while the stock market doubled.
Right. And then, but the real decoupling is when it stops being the leading risk asset and starts being an asset that investors are hiding in rather than long bonds. And that would be the interesting turnover. But I don't think it's going to happen in a period of days. This is going to take a while. It's going to demand over $1 trillion of assets in that one protocol in order for it to have enough liquidity not to continue to have the volatility that it has had prior to the last few weeks.
That's my thesis as well, except I think the timescales are getting compressed. I mean, if you look in 2008 at the bottom, gold bottomed. 3 months later, gold went on an epic bull run while the rest of the market was still languishing and dropping. But it took 3 months. It took 3 months for gold to delink from the market. If you look in the Great Depression, homestake mining, which was because they had outlawed gold, so homestake mining was the biggest gold company, was the proxy. Same thing. It went down with everything else, and then went on an epic bull run throughout the 30s. The fact of the matter is, I think we're setting up for something very similar to that. I also, have a bit of a conspiracy theory in my head, which I think you probably would find amusing, Scott. I would actually would not be surprised if the DOJ was trying to time what they're doing with Binance for when the SEC post their newest comment period, whatever, decides to approve BlackRock and Fidelity in the fall. I would not be surprised to see those both things happen. In which case, what you would see is Bitcoin dominance going crazy to the upside.
Everybody sells all their altcoins into Bitcoin.
I don't think altcoins are as monolithic as most of the people in the crypto community think. I think there are some projects and some things which have.
I just mean for dominance to skyrocket.
Oh yeah, but
in an environment where we have a washing machine of liquidity, that means the altcoins are going into Bitcoin historically.
Yeah, that's right. But I think that's definitely a possibility. But I think that it's really important to understand the dynamics of this volatility drop that we've seen in Bitcoin mean that there's much less to be sold. I think the beta to the downside will be less than the beta to the upside.
100% agreed. 100% agreed. Yeah,
that's the one thing that I do think. And so, if you put the probability of a 25 or 20 to 25% correction at 50%, then basically what you're saying is there's a 50% chance that Bitcoin, I think, drops 10%, and a 50% chance that Bitcoin goes into a big rally mode when these decisions happen. That's how I sort of handicap it. So,
and it'd be very difficult to time that. So if you,
I don't even want to try.
The prudent thing to do is to have your stink bids down low, like way down there, and because these exchanges they'll go offline. There will be massive liquidity, pushes and pulls, and you will not be able to get in there and execute these trades and be. We've all heard it. Don't get cute. Just don't get cute out there. And then
right. I think that Mike's point is there. I mean, look there. If you look at we keep talking about this in the concept of risk assets, but the truth of the matter is you really have to look at valuation ratios, price to sales, price to free cash flow, price to earnings if earnings aren't massaged as much, and where they are. And we are at highs. If you want to look at affordability, look at asset like housing, there you want to look, the fundamental is affordability. We are at lows. Yeah, which of course is inverse thing. I mean, these are the things that Mike always wants to point to, and he's right. I mean, but it depends on where. But even housing, it's different here in South Florida or in Florida in general than it is in New York and still San Francisco and other and big cities. So fundamentals matter at some point. And we've had a market where fundamentals have really been, I don't want to get all Cliff Asness on this to say fundamentals have gone totally off the rails, but the fact is
largely ignored
in liquidity, and fundamentals do matter in the long run. And that's what that is the constant drumbeat that we hear from Mr. McGlone, but he's not wrong. I don't disagree.
Well, so that's a key thing also. I want to point out two facts. Completely agree that it's a one-to-one correlation we all worry about. I'm not really so much worried about it crass. I'm just looking about normal historical retracement in value of all these assets that are elevated. But here's the key thing I want to leave you with. Bitcoin and cryptos are very, very bullish for treasuries. And here's why. Stablecoins. Where's all that money going? That's one thing I love pointing out. Since 2018, you look at the amount of crypto dollars, it's up like 4,000%. The Bloomberg Galaxy Crypto Index is unchanged. All that speculative money, if you're smart enough, you made some money on some of these bogus coins. Where's that money going? It's going into stable coins. Look at Tether, $83 billion now. It's more than some countries holding U.S. treasuries, and they're getting 5%. Like, okay, cryptos are great for treasuries. I think our leaders need to figure that out.
Well, that's true.
That's where that money's going. It's going to treasuries. It's not going to stable coins that hold the yuan. It's going to T-bills.
Yeah. I think the bottom line is everyone here is bracing for something to come and doesn't want to put a time or a price on where it heads, right? That's how I feel about it. Okay, it's 10 o'clock, but I want to ask a very quick question, go around the horn. Not expecting it necessarily to fill, but if you were trading this, where's your bottom Bitcoin bid right now for the next year? I'll put mine at 20. I think if everything goes bad, Bitcoin still makes a higher-ish low. That's what I think. So I'd say 20.
That's interesting because I was going to say 19,500 because 20 is what everybody expects. And
well, yeah, the 20-ish. I agree. Yeah. If you're expecting 20, you get 20,500 or 19,500. You never get 20.
Exactly.
Right?
Exactly.
Dave, where would you bid?
I'm more bullish than you. I think it's going to be very hard to push it for any size.
25.
Between 24 and 25,
yeah. That so the 24-25 is I would give it a 50% probability of filling. The 20 is the holy shit, I can't believe we got here bid of filling. But Mike, what do you think?
double bottom, which is around 15.
15. Yeah, I wouldn't be surprised at all. But I assume, do you believe, really quick, if we double bottom on Bitcoin, do you believe that stocks have made a newer low or are also double bottoming?
Yeah. Oh, yeah. No, I think that's going to be the tide going out. Bitcoin will show its divergent strength eventually. But right now, you have to admit the last few months it's showing divergent weakness. We have to get to that point. At least show me the beef.
Yeah, totally agree. Power Blaster would like you guys to know that I've never been correct. And I would like to confirm that my crystal ball is broken. It sucks. Just I try it. I do the magic 8 ball. It says 20K, and then it does. Yeah, fuck. Yeah. Anyways, yeah, it's hard to make predictions. That's why
there's a very real chance that we've seen the lows for this cycle. I really do. I mean,
I think we've seen the lows for this cycle, and even if McGlone is saying we match the low, that means we've kind of seen the lows for the cycle. And in past 4-year halving cycles, we generally make a slightly higher low at some point after this lack of volatility before shooting up. So I do expect that we will see some retracement at some point. Guys, James, it's so awesome having you here. I'm not saying that the three of us weren't amazing, but it's nice to have some new blood and get some fresh opinions shared, obviously. Everybody knows the three of us what we think at this point, right? So, guys, thank you very much. James, it did, in fact, get light behind you once again.
I told you, the sun always rises.
It is. See, guys, it's gonna get better. Perfect. Thank you, guys. Follow all three of them, please, on Twitter, of course. And Dave, I want to say your YouTube rants or reviews on CoinRoutes are criminally underwatched, right? Do you do that every Friday? I was watching it
pretty much every Friday on YouTube on the CoinRoutes channel. Yeah, I generally post it on Twitter as well and LinkedIn. You know, I know you weren't around this week, and I often watch your 9 a.m. rant and try to make sure I have every one of the cool stories.
My Friday rants have been less aggressive than in the past. My rants are less volatile like Bitcoin these days. Anyways, guys, that's all I got for you. Thank you so much, and we will be back. I'll be back, of course, tomorrow, but the quad here will be back next Monday. Thank you, guys. See you tomorrow.
Thank you, guys. Thank you.
That's dope.